Aziz Hamzalar, you own both Google and Facebook in the Loomis Sayles Growth Fund. Now, Google's going to be occupied for a while with their European antitrust problems. So what does that mean for both Google as well as their competitor, Facebook?
Yeah, in both of these companies, we like the same characteristics. First, both of these companies really benefit from great brands that will be very difficult to replicate, and they have an advantage of network effect. They have platforms that will be virtually impossible for someone else to come and replicate. If you look at their market shares, Google it really dominates its space. They have 1/3 of the online advertising market, and Facebook has around 8% of the advertising market. In both of these companies, we expect them to gain market share going forward. It's a big market, $800 billion in advertising spent, and only 20% right now is in online, and we expect that number to increase over the coming years. So in both of these cases, we really like the secular growth. And in terms of the Google and antitrust, we believe that the key drivers for the business will not change over the long term, and it may have an impact on their business, but at the end of the day, if you look at the history of regulation and how it impacts these companies, by the time regulators catch up with these companies, it's a fast evolving technology business. We believe that it doesn't change the overall structural dynamics for the company.
Staying online, you're also bullish on Amazon. Now, Jeff Bezos can get involved with the Washington Post and with drones, but will 2015 be the year that he really concentrates on profits?
Yeah, I mean, make no mistake, Jeff Bezos is really very much focused on the core businesses despite those other interests that he has. We believe that Amazon has a great brand and has tremendous scale, and those competitive advantages really provide the company all the things that we are looking for in an investment. We are very long term. We take a private equity approach to investing. We own this company actually since 2006, and when you look at the characteristics we are looking for high quality businesses that have sustainable and secular growth when they trade at a significant discount to intrinsic value. And Amazon meets all of those criteria. First, they have a great brand, as I mentioned. They have a scale that is unmatched. They offer consumers three things that they care about: low prices, convenience, and selection. And we believe that if you look at the overall retail market, which is $13 trillion globally, only 6-7% of that is online today. And when we invested in the business, it was low single digits. If you look into the future, we expect that number to increase and Amazon to benefit from that disproportionately. And we expect actually significant cash flow growth. As you mentioned, they have been significant investment cycle, but we believe that going forward, the company should benefit from its scale.
And then finally, you are a fan of Monster Beverage. Now, Coke owns a piece of Monster Beverage because, well, people are drinking Monster Beverage, but they're drinking less Coke. Do you think Coke is going to step in and buy more of Monster Beverage? What's going to take that stock higher?
Yes, we owned Monster since 2013. Actually, that was the only investment we made in the entire year for 2013. It just shows you our selectivity in our investment style. And in terms of Monster, it is one of the two leading brands in energy drinks. It's Red Bull and Monster. Those two companies have around 45% global market share and 80% of the US market. And it is the fastest growing category within beverages. If you look at per capita consumption globally, it's one of the lowest categories. And that's what attracted Coke to make an investment around, I think, 17% into Monster Beverage. For Monster, the big opportunity is international markets. Today, around 80% of the revenues are from US, but if you look at outside of US, Red Bull is almost 7 times the size of Monster. So what attracts Coke is this, immediate distribution capability around the globe. And in terms of, more ownership, I think that really depends on Monster's current CEO and CFO. They own together I think around 20% of the company. So they're a major stakeholder. So it really depends on what they want to do with the company in the future.
All right, thanks a lot, Aziz.
Thank you.